me start with a sort of broad question. Earlier this morning we had a session with some of our pension fund CIOs, and the exam question there was, what's keeping you awake at night? Now, I suspect the answer for you might be perhaps one of your 9 children, I don't know. But from a Newton perspective, from an asset management perspective, what is keeping you awake at night?
Yeah, it is a question of where to start, isn't it? But I think the single biggest item, certainly as far as I'm concerned and what we think about mostly at Newton, is really, I guess, the risk of a big policy mistake. Obviously, I mean, the bull market, the S&P 500 celebrated its 7th anniversary of the bull market yesterday, which is quite extraordinary. Has been built really on a giant experiment, a giant monetary policy experiment, which has seen us go from sort of low rates to no rates to QE to now negative rates. And obviously, while we'll be on this stage, we should get an announcement from the ECB and obviously some quite widely expected to cut negative rates further. We worried at Newton that actually this may have turned out, perhaps it was the right thing to do in the first instance, but to have massive unintended consequences and actually be almost like the opposite of what should be being done now, particularly, you know, the fact that we now seem to be stoking deflation, if that doesn't sound contradictory. Yes. In a world, you know, just think about it, where you actually, in many countries, now, if you're a debtor, you're paid to borrow, and if you're a creditor, you have to pay someone to lend them the money. I mean, this is quite an extraordinary sort of Alice in Wonderland moment, and I don't think we've quite worked out what it all means. Obviously, earlier this year, we saw the markets wobble as there was this sudden doubt over whether policymakers can do whatever it takes to stimulate growth and to enable us to improve the sort of still structural debt in many countries. But I'm quite worried that we will have, in fact, I just sat through the previous session, which was so interesting about, you know, tail risks, but there could be a very significant unforeseen consequence. And we're kind of a bit sleepy, I think, at the moment about what that all means.
And do you think we're getting a clear enough direction from policymakers on where we should be going?
Well, no, I mean, I don't blame them in a way, because as I say, it's been a huge experiment. It's not like you can dust down the history books and say, well, what happened last time we did this? There isn't any example. We can look at Japan, obviously, as the closest thing, but that's not exactly a sort of uplifting story, particularly. So, I mean, I think what they did at the time of the financial crisis was completely spot on. You needed to do something very significant, but what was sort of like emergency sort of A&E treatment has become sort of regular medicine, and the evidence suggests, I mean, obviously what was supposed to happen, you did asset price inflation, you managed to stimulate demand and get to consumer price inflation. Instead, what you've had is just an abundance of capacity in so many services. Great for lots of us as consumers, but not so great in terms of where it all ends up, I think.
And I suppose from our perspective, you know, one of the things we said when QE was first introduced, as you say, is that sort of initial emergency shock treatment, was, you know, we understand why QE is being introduced, but there were big unintended consequences, and I think the government didn't quite say we were collateral damage, but sort of more or less the government at the time said we were collateral damage, so, you know, just kind of get used to it. Well, that's sort of okay until you're trying to then work that through in your pension fund deficits and thinking about, you know, where do pension funds invest? And so, you know, throughout this conference, and I think you know, the Robert Wall from RBS said this morning, you know, we're being forced into buying gilts, partly through the regulatory structure, but we're being forced into buying gilts when actually that's the sort of last thing we should be doing. And so those consequences don't quite gel and quite come through for policymakers.
No, and I think, you know, it is time to, what we tend to do is sort of extrapolate again. You know, we are all very much creatures of habit. We think, oh, well, this has sort of been vaguely working a little bit, think how much worse it would have been if we hadn't had the stimulus. But obviously, kind of, as I say, going beyond the sort of Rubicon and getting into negative rates, I think will have very significant ramifications in terms of where you can invest with a positive return for your money. It'll obviously have big implications for many of the challenged banks, say in the Eurozone. I mean, there are lots of sort of already rather strained situations. So I don't want this all to be bad news, but, you know, there is this big, you asked me what keeps me up at night, and this from a financial market perspective is very much high on the list, or highest on the list.
Well, let's look for some positives. And from our perspective, one of the positives is the FCA's review of the asset management industry and that sort of asset review that Tracy McDermott talked about at the conference yesterday is something which we've very much welcomed. Your views on that, and the Investment Association's views on that too. Yeah, no, I mean, it's still styled as a competition review, and it's clearly not that in a sort of classic competitive market study, in the sense that I don't think what's being drilled at here is related to, concentration of power in any individual fund management house. It's much more, I think, about, and obviously there's been a lot of talk about this, the end outcome for investors, obviously including pensioners, very much. How much does that, how clear is that from the way the industry is structured? The intermediation of our industry, I think, is a very significant point. There are obviously one or two areas that are under the focus of attention for more sort of oligopoly sort of sense, but I think it is a welcome development. Obviously, it's a lot of work for everybody, but I think if we can somehow improve the connectivities between what asset managers do and what savers feel, in terms of the result they're getting, and being able to judge that they're getting value for money, for example, that would be a good thing. So John Kay talked about this in the session we just had with him, and I'm not sure if you managed to catch all of his session. I caught some of it. I caught it in the speaker's room, and it was fascinating, and then I saw he ducked the question on Brexit, which will no doubt We're going to come to that. But he very much said that the industry's lost its focus, and that we're focusing on rules, and the regulatory structure focuses us on rules. And I think if you'd have come down to the session we had in the Learning Academy, in the Academy Learning Zone, during the coffee break, he was slightly more robust in that sort of smaller setting about what he had to say about regulators and their rather narrow focus. His view was, well, we're focusing very much on rules, and what we should be focusing on is structure, but also conduct. Because his thesis was that investors have lost contact with their investees partly because of the intermediation. So what can we do about that then? Yeah, so I think it's entirely valid what he's saying, and obviously sometimes it's a bit like the frog in water, isn't it, that gets boiled. I don't think anyone set out, the whole scheme was set up so that every piece of the chain would sort of make sense in of itself, and it would be done by experts. But then you end up with this huge long chain between the end investor and, say, investment managers. And I do think that makes it quite easy, rather, to lose sight of the fact that you're doing something that is aimed at achieving something of social value for a person. If you dehumanize, if you depersonalize things, it's very easy for end up thinking you're doing something great by talking to each other. And I think it's a good call. I mean, obviously going back to his review, when was that now? 2012, wasn't it? I mean, he talked about this at great length in his review, and it is a great shame, I think, that 4 years later, we haven't really made any progress. I do think it's a missed opportunity within the FCA's market study of asset management that they are not including the IFAs and the platforms. Obviously, they are including the investment consultants, which is a big part of on the institutional side, a big intermediary. But I think we do need to look holistically at the structure and, really say, if we are going to get to that point where both the fund manager is going to be doing something that is genuinely of value to the end investor, but also the end investor understand what they are buying or how it's going to help them or not in later life. That's really, we've got to go back to that. And it is a bit frustrating that we go into the minutiae often. And sort of taking that step back then, John Kay was also saying that we've, and it's a thesis of his Other People's Money book, isn't it? We've just lost focus on what we are here for. We're failing to ask ourselves hard enough that question of what are we here for? And it's almost become a justification in itself that, we're here to, he was saying, trade, and we're talking to each other and we're trading with each other, but without taking that external view. So what is it that the FCA could do, or through regulation, or we could do ourselves working together, on the buy and sell side of the industry here, to start to break through that conundrum? Yeah, I wouldn't leave it to the regulators, not because I'm saying anything negative about the regulators, but I do think it's up to us to look at, hold a mirror up to ourselves. It is quite, and this is not an excuse, this is just a sort of fact really, certainly as I see it, that it is actually, the way we've structured ourselves, it's quite hard to be disruptive within. I know it's a recurrent theme of your conference over these few days about disruption and the sort of threats to traditional managers and so forth. But actually, if you are a traditional manager,
And this is not meant in any way a sort of sob story or a complaint. It's just, it's just a reflection that actually it's quite hard to change things from within. So you can have a focus, as I have done, obviously, on diversity. We've been working together on a focus on talent more broadly and culture. How do we account for that? I am optimistic because I do think that you have, there'll be a confluence of things possibly, and I hope it's not through another market debacle or problem, but I do think that there's the pivot point of people who think, actually, you know what, if we're going to attract the right people into our industry, be valid, be future-proof, then actually we need to kind of get our own house in order. But what you do in the first instance, and I suppose the 30% Club experience taught me this, I didn't realize it so much beforehand, was that you need to create a real joined up sort of sequence of people and initiatives and change, and the penny drops suddenly when people realize it's in our own interests to do this. When you're kind of knocking at their door saying, actually, you know what, I think we should change, we should be more transparent about fees, we should be more sort of, helping people to understand an aspect of what we do, then people inevitably are a little bit, we'll think about that. Whereas actually when you realize, do or die, that can change. But
isn't that part of the point?
Urgency.
That, we only get to that do or die point when there is a crisis. And how can I put this gently? Left to our own devices, we might be quite happy with the status quo. And whether that is on things like diversity or whether that's on culture or the way in which we do business and the way in which we do, speak to ourselves. So, without that external shock, which might be a market shock or it might be a political shock, are we going to make change more rapidly enough?
Well, I just have to believe, just this kind of way I'm programmed, that actually we don't have to have that inevitability. Well, but it's a kind of call to everybody, really, because I do see, the incumbent dominant players in our industry, certainly from an investment industry's position. There's a lot of inertia in lots of elements of the chain at the moment. So you get people sort of who do seem to be more clinging on to the past, often just getting lots of inflows, being recommended by the same. So it's almost like a call to action that everybody has to take one step there. I hope that we learned from the disaster that was the financial crisis in 2008 about the dangers of, groupthink and just kind of doing nothing about it to fix ourselves. But I'm not exactly relaxed and complacent about it. So.
I don't think anybody here is or can be. Let me just ask you one final question on the FCA review before moving on. I mean, do you think the market just is so complicated and the number of firms and transactions so high that it's just impossible to see it, and we just need some consolidation in the market?
Well, I don't think it's so much consolidation of pieces within the chain. I think it's that chain needs to be shrunk in terms of how many pieces there are in the puzzle between, say, a person who's going to benefit or not from what's done with their money and then the person investing it. And that's where I think that we need to, I think it's a bit of a miss that we haven't got the platforms and the IFAs that are a big part of the whole chain included. It's perhaps not too late as we get into the whole review, and there are obviously other things that are being done in other parts of government and the market advice review and so forth that could be swept in.
On those specific parts of the chain, IFAs, platforms, what sort of action would you like to see from the FCA?
Well, I think it's just checking, one of the questions that they're asking within the market study is to what degree are fund managers motivated to ensure there's value at every stage of the way. And we might be very motivated, but as an individual fund manager within the whole group, there's apparently something like 6,000 different managers from small, medium and large. That must include some very small ones in that. It's quite hard unilaterally to do very much. And therefore, I think that needs to be looked at, just as they are looking at with the investment consultants, and the issues obviously around potential conflict of interest between fiduciary and advisory, but also the more dominance of the top consultants. I think it's estimated that the top 3 pension fund consultants control maybe or have influence over about half the pension fund market in terms of who they recommend as managers. And that's obviously a source of concentration risk. But I just think without knowing what the answers are about how to streamline it more, then it needs to be included in the review.
I'm going to change track slightly. And you touched on the work that we've both been very, very keen on around greater disclosure and workplace culture to have more prominence in corporate reporting. We published a report last year called Where's the Workforce in Corporate Reporting, which showed that actually, companies are very keen to say our workforce is our greatest asset, but as investors, we actually know next to nothing about the makeup of the workforce, diversity in the workforce, conditions in the workforce, or any of those issues. So interested in your views on that and how we might work together to promote that agenda.
Well, first of all, I'm a firm believer in collaboration, the sort of whole being greater than the sum of the parts. So I welcome the chance to collaborate on this. I think it's, most people would say, as you've just said, the companies would say talent's the most important asset. And I think most investors would say, actually, that certainly on terms of managing risk in terms of investments, that if you don't have the right culture and you don't have those who are going to drive future value at companies, then you're not obviously going to, well, you can't be as relaxed as if you are confident that you have those things. And it's not just the financial services companies. Obviously, there are many other examples where things have certainly gone wrong when you haven't had the right culture. But clearly, there have not been the sort of progress around, the shift in tangibles to intangible assets within either accounting tools or in terms of the lens through which most investors assess companies. So what we've been working on, and it's as well as the tie-up with the IIA, the Investment Association, and the PLSA, we're also working with other groups. There's been a sort of consortium of more HR professionals that have called their initiative Valuing Your Talent, to actually see if we could, a lot of these things seem too difficult to solve. But yet we know they're so important that we've got to try and solve them. So we've been working on a framework. Your publication last year, I think, is a great effort on. I don't mean that in any way sort of patronizing. I think it's very hard to solve this in one. It's very thought-provoking, some very practical ideas. Last November, we hosted an event at the London Stock Exchange that brought a lot of these voices together, including non-executive directors and chairman of FTSE and other companies who've done a particular good job in terms of elevating this in terms of not just being a nice sort of soft, we talk about this, but actually they measure it. I do think, again, going back to the point of, investors need to ask. Again, we can't blame anybody else for, there aren't the tools, therefore we won't measure it. When you know that the biggest real estate company, in the world doesn't own any real estate, Airbnb, and when, Uber doesn't own any taxis and things, you have to come up with new tools. I mean, we've just got to come up with new tools. I love the fact that a conference like this, bring lots of people together, and hopefully everyone goes back and says, actually, now I'm going to throw down the gauntlet to my own analysts, or I'm going to ask my fund manager what they're doing about this, and we can create more momentum around coming up with some metrics. So it won't be perfect, but something I believe is often better than nothing.
And that's certainly what we're trying to do. We've had we're just about to have one, we're just about to have a couple of other roundtables bringing investors and companies together so that we can discuss what those metrics should be. Because again, it's a bit like some of the debates we've had on corporate governance, other aspects of corporate governance in the past, isn't it? Companies say, well, we don't give the information out because the investors don't ask. And investors say, well, we haven't got the information because companies don't give it. And we need to break through that logjam and having some common language. Going back to our Tim Berners-Lee session yesterday, sort of HTTP for investors to be able to ask the right questions would help. And I think if we can work together across the investment industry, then that would be very helpful.
I'm afraid I wasn't there for that session, but Tim Berners-Lee did come and speak at a BMY conference that we hosted, and he shared with us, I don't know if he did yesterday, that when he first came up with the idea of the World Wide Web, he had this memo that his boss had scribbled on, vague but exciting. Yeah? Well, that became a bit of a motto for me, that you can be vague, but I mean, not that any of these initiatives might have the same import as the World Wide Web, but it's very important to think big, start small, but start now. Get on with it rather than looking over like, we don't know where to go.
No, and I think that's really important, and it's certainly part of what we try to do is you can find 1,000 reasons for not to do something, but actually you've got to start, and you've got to start somewhere. Exactly. So again, we'll be starting small with this initiative, thinking about the data, the key data that are easy to come by, easy for companies to disclose, and then trying to build out from that, build on from that. So great if we can continue to work together on that. Now, one of the issues that obviously you've been working on hugely, and one of the great one of the great changes that you've been able to is around that sort of issue of gender diversity, setting up the 30% Club and being a real advocate for seeing more women on boards. And we're at a sort of particularly in the pension sector and in the investment sector, a particularly positive moment, I think. I think you were saying you're the first female chair of the Investment Association. We've got our first female chair of our association.
Taking over now.
I know, everywhere. Female pensions minister, Leslie Titcombe at the pensions regulator, and Tracy McDermott at the moment at the FCA. So, really sort of great news. But we haven't gone far enough, have we?
No, and I think just to set the record straight as well, because my interest in all this, although I'm not in any way ashamed, and I would call myself a feminist very happily, and I'm not ashamed of being associated with the gender diversity, but to me it starts with wanting more cognitive diversity and actually wanting to avoid the groupthink that we had seen that caused so many difficulties in the past. And obviously, gender diversity is a very good place to start with 50% of the population. It looks very old-fashioned, certainly the fund management industry. I know Best Invest do some data every year, and well, at least the past 2 years, and it shows that only in this country, when you look at retail funds, only 7% of them, that's not 70 or 17, that's 7, are managed by women. And, it's very difficult for us to attract even, I think, because we kind of we suffer from a few problems, I think. First of all, a lot of people in the I won't say the man in the street, because it shows how easy it is to fall into the nomenclature, but anyway, people in the street wouldn't necessarily know what fund management is. And then, of course, if you're a diverse candidate from any different sort of underrepresented group, you're most likely to meet people that don't look and sound like you, and sort of you might feel quite concerned about how far you can progress. So actually, I would like to use this moment to announce a new initiative focused on improving graduate recruitment diversity across socioeconomic background, ethnicity, as well as gender. It's a group of people from a couple of the big pension fund consultants, Sarah Bates from St James's Place, some of the other asset managers, and just in the freelance investment association, the CFA, Society, the PLSA. So in a kind of, we haven't come up with a wonderful title for it, but diversity in savings and investment is the mission. And it will be focused, again, not trying to boil the ocean, try to fix, the boardroom or the executive management levels or the people who are running portfolios right now. But if we don't fix or try to improve the diversity of the intake so that we have good cognitive, diversity, so we have a lot of ideas, a lot of multiple perspectives brought to bear, then I think we will be in danger of looking increasingly outmoded. So I'm excited by that. It's certainly not, driven by me. It's this group, and but they gave me their blessing to announce it today, because I think it's there's been a lot of talk about this. Various individual companies have done quite a lot of work in terms of their own graduate recruitment. A few initiatives around, the Investment 2020 that is trying to encourage graduates who might not have the traditional sort of Russell Group university backgrounds through apprenticeships. So there's lots of things that could be brought together again, the whole being great in some of the parts, but also some gaps, and I suppose getting the word out about what fund management is and trying to make sure we're not, again, to use that word, complacent, that just because certainly my generation was keen to work in the city and keen to work in asset management, that the next one will be equally keen. So yeah, I think let's not dwell too much on the fact that we've got a mountain to climb, and more take a step on that journey.
Well, certainly that's something which we're very excited about, and Leslie and I will be very keen to join that group. I think you had a meeting yesterday, and sadly we weren't up here, so not able to join it.
We didn't time it deliberately that way. It's just,
But we will certainly be very keen to take account of that. And I'm reminded of a point that Leslie Titcombe made actually at a chairs dinner that we had, that we need to think about what that looks like from inside the pensions industry too, in terms of the women who are coming through as future leaders of this industry, and on the trustee side as well, where again I think there's a lot more that we can do.
We talk a lot about risk management, and again, the session in this room just before was fascinating. I'm a firm believer that men and women are equal but different. That actually we do work better when we're joined together, and actually it's not stereotyping, it's neuroscience, that shows that women on average, or it's less controversial to say it in terms of feminine qualities of empathy, and then you have masculine qualities of systematizing. You need both if you're going to be an active, successful fund manager, if you're going to have great decisions taken about pensions and or your new initiatives to the commission and so forth. You need multiple points of view, and that's really what this is all about.
We're very keen to support that. I'm going to ask you a couple of questions about sessions that are coming up this afternoon on climate change, and then we'll throw some questions out to, we'll throw it over to the audience. But later today, we've got a panel session on climate change with Christina Figueres, who obviously sort of led through some of those huge changes and huge decisions in Paris at the back end of last year. How important an issue is it for investment, the investment management industry? There is still a sort of slight view I get of, this is kind of, I won't quite use the words that have been used to describe it, but sort of green, whatever you want to call it. And this is a peripheral issue, it's not really something which is central, and it's just, a bit more political correctness that's being forced on us.
All right, so this is my opportunity to say, let's not take that view and let's use this huge opportunity to, for once, get ahead of a financial risk. I would commend anyone who hasn't read Mark Carney's speech that he gave at Lloyd's of London last September, I think it was, that was very dramatically entitled The Tragedy of the Horizon, where he talked about the fact that we know we absolutely know there are financial risks associated with climate change. Obviously, there are human risks associated with climate change if we don't address that, but there are also financial risks, given the fact that actually, by the time you add up not just the energy companies and so forth, but actually others like utilities, then companies that have some risk around this issue make up around a third, in equities and bonds, make up around a third of not just the FTSE index, but listed securities throughout the world. So we know that we can either, his speech was all about the fact that, we see this coming, but everyone says, oh, well, it's not yet. So we won't worry about that just yet. We'll park that one in the corner. We've got lots to worry about, and clearly we do. But let's not grapple with that issue. That would be a mistake, I think. That would be one of these things where we would, sleepwalk into another crisis. Actually, I am working with Christiana. We're co-hosting an event in April. If anyone wishes to come, please do get in touch. It's Jane Ambassador, who's from Mercer's, who's speaking later today as well, is also speaking there. But we'll be talking about two things. One, we'll be talking, we've called it 2 degrees of change, obviously a bit of a play on Christiana's goal that she's been so successful in terms of changing the dynamic towards reaching, but also the fact that one change can help lead to another and the compounding effect. And she had approached me actually at the Guildhall event last October on climate change and the financial aspects of it, to say, look, could we in some way use the fact that we have a higher proportion of women in senior roles now? Obviously, we know there's still a lot of work to do, and women do tend to, going back to the neuroscience, and there's plenty of empirical evidence showing that when there's a better gender balance on a board or in a senior management committee, you get more attention paid to what might have been described in the past, before Law Brown said not to use these words, as CSR type issues, but longer term issues. Yeah. And I think, the point of that is to prioritize, to escalate, to elevate the priority being paid and the attention being paid to this issue. But the second piece we're going to be looking at is trying to come up with some very specific, practical suggestions for investors to grapple with this now. So we have a guy from the FT Russell group who've developed a sort of a measure of how to measure carbon intensity of investments now. We have Bloomberg there. We have some very sort of practical suggestions. And again, if we can create a bit of a joined up thinking here. So pension funds consultants like Mercer's are asking, to what degree are you considering this issue and making sure their clients, our mutual clients, the ultimate asset owners, are also cognizant and are focused on longer term horizons. Right the way through to actually what can we do now to measure some of these financial risks. And I think we can manage the financial risks associated with climate change. It is a bit of a shame that we have to keep saying, oh, it's not all about being green and it's not all about telling everyone to recycle, although we obviously must do that too. But it is actually about gripping an issue that we can see coming down the road, and let's not wait till it hits us.
So that's a social issue with a risk and financial overlay. So going back to one of the points that John Kay raised, and again, it goes to the heart of his book. I'm sure sales in his book will have gone up enormously as a result of our conference. We should be on a commission, I feel.
Should. That's a good plug he got for it.
Well, yes, and I'm continuing to plug it. I promise you that I'm personally not on commission. But part of his thesis was, actually, as the guardians of other people's money, And given our role in managing trillions of pounds, is there a social role for what we do? Is there a social overlay in what we do, or should there be?
I think there should. I mean, one thing, I would just encourage more people to do this. So one of the reasons why I now speak up, for example, on Brexit, and we can come back to that, but is because I mean, to be honest, it's partly because of a bit of conscience about the fact that Newton used to be the largest holder in Northern Rock, the largest shareholder in Northern Rock, back in 2002, and by 2005 we'd sold out completely. And it's always weighed on me that we didn't kind of, it was good for Newton clients, but we didn't sort of raise a red flag. We didn't predict the company's, collapse. That wasn't behind it, but we did see the problems that did cause its demise were the things that had concerned us. And I feel that we as an industry could do, and it's not just to speak up for the sake of it, but actually if we influence we can influence. I mean, this is actually, we own the companies. The management of companies don't own the companies. We own the companies. We also can have a view influencing government policy and other policy by engaging. There may not be an immediate payback. In fact, there invariably won't be. Mm. But it's actually would help us certainly in the long term in terms of positioning, and it would also help us, I believe, to be clearer about what we're trying to do. For me, the important part is the services part of financial services. And, it is, it's embedded in the descriptor, really, that we are supposedly providing a service. And I think that by losing that aspect, then, and sort of focusing on the financial part, then, we end up being weaker for it as an industry.
I'm going to ask whether the audience have any particular questions or comments or reactions to some of the points that you've made, Helena. Hopefully get the house lights up so we can see.
Stunned into submissions.
Question down at the front. I will say, can you tell us who you are and where you're from? But that's Richard Butcher from PTL, and a board member of the Pensions and Life
This is a game we're going to play with, everybody in the audience.
So do you know my question as well?
Go on.
Surprise us, Richard.
So I was going to ask about transaction costs. Yeah. So this is something we're gripping with. It's parked in Europe. It's parked with the UK regulators. Mm-hmm. The Investment Association has been grappling with this a little bit as well. Where are we going to get to? When are we going to get to a solution? How are we going to do this?
So can I just sort of focus particularly, are you looking at the sort of advisory commission paying for, being used to pay for external research? Are you looking for transparency on all aspects of fees? Are you?
So the transaction costs incurred in the buying, selling, borrowing or lending of assets. So these are excluded at the moment. I'm thinking in particular around DC because this is where it's going to be quite tricky, but it's going to come in DB as well. If we're doing it in DC, it's got to follow into DB. So we have to assess the value of transaction costs. Now, it's a slight oddity, isn't it, in the sense that transaction costs are a drag on yield, so really we're only concerned about net returns, except that the regulations specifically require us to consider the value that's inherent in the incidence of transaction costs. So it's those costs of buying, selling, borrowing and lending.
So my personal view, and it is something obviously the IA has been working very hard on, is the more transparency, the better. I think that the one thing that I worry about a little bit, because obviously we've been working very hard on trying to give people a sense of the whole economic cost of ownership of a fund, and then you get sort of a number in the case of a single fund, then it would be obviously how much per £1,000 you are spending in terms of pounds and pence on the cost of owning that fund. The only danger with that is if then people kind of don't look behind that and understand, I think, the individual underlying costs. So I'm for an aggregate measure. Obviously, we've been talking a lot about ongoing fund charging and not looking at the AMC and so forth and making it very much more holistic. But I think we need two things. One is the aggregate so people can see the all-in costs, including transaction costs, and then underneath that, obviously how that breaks down. The one area where I feel it's dangerous to try to guess what your transaction costs will be the sort of execution-only dealing costs, because you don't know those a priori or ex ante. You only know those ex post because you might have a less liquid or a more liquid market. So that's the only area where I feel it shouldn't be swept in, but actually we should declare it afterwards.
So two brief supplementary questions. One is, with total disclosure, a single figure, do you think there's the risk that people will start making the decision based on price alone as opposed to value? And the second one's gone from my mind for a second. Hang on, answer that one and I'll remember the other one.
I do worry about that. I think that we've got to move away. I mean, clearly one of the big things within the FCA study, again, is about justifying, active management. And there is one line in it, which I can't remember verbatim, which implies, all the costs of active is so much higher than the cost of passive, and it worries us that so much money in this country anyway is still going into active management. Now, clearly, you should be looking at, as you say, the post, the all-in costs, and whether you have had value for money, whether the outperformance that you might achieve is worth that extra cost. I think they're completely right to focus on closet index that's priced as active, but I do worry a little bit that people need to understand what is the difference, and that cheap doesn't necessarily mean better. I mean that's true in other industries, isn't it? You buy but it doesn't mean that expensive is good.
Yeah, and when I was talking very, very first thing this morning, I talked about some of the asset management differences in asset management fees that we unearthed last year when we did some research for effectively the same thing with effectively the same returns. I think it was a global equity mandate. You could pay anything between 45 and 90 basis points. Twice the price for effectively the same
Well, you'd
product.
want to have twice the added value,
Would you
wouldn't
have twice
to
the added
make
value?
it?
Probably not. We did, as I said earlier, we did take account of return in all of that.
Yeah.
And for other mandates, for real estate mandate, global real estate was even wider, at 32 to 200 basis points. Now, that seems slightly wonky.
Clearly, and I think they're going back to the point of what costs should be disclosed and how it should be disclosed. I mean, clearly there are sort of very small print type costs that can, like admin charges, that can add up to a very significant absolute amount of money, which over years obviously eats in hugely to the returns for the after costs returns. Then if we're not going to be at risk of disruption from whole new waves of entrants, then this is one, I think, maybe painful for some individual managers that have too high admin costs, but it will be an easy one. Just say, look, let's disclose all of that, make it very clear, and then if we are charging the right fees, then people will pay.
Has that been long enough, Richard, to think of your second question?
Yeah, it has. But I'm happy to give way if anybody else wants to ask a question.
You're on a roll. Carry on.
All right, fine. Okay. So, well, actually, it's a slightly mischievous follow-on question from that last round. There is a perception that we're not making very much progress on transaction costs. We do need to move forward on transaction costs, and I'd urge you to support that and help us drive that forward. But one of the reasons for that, one of the byproducts of that perception that things are slowing down is because the asset managers don't want to tell us. Do you think, and this sort of mischievous question, there are some horror stories in there, when we get transaction cost disclosure, are we going to find those fund managers who are charging 500 basis points, 600 basis points and just not telling us?
Well, I'm not familiar with any example that's as egregious as that. I am familiar with, obviously, I'm not going to disclose anything further, with some that I feel are very high compared with others, and that people wouldn't have focused on them. And I think that is wrong, does the industry no good service at all, and it should be, it should be all at the, I hear you on the challenge to go back to, and I know I've got colleagues from the IA here who have been, been trying to be at the forefront of this, but I think accelerating the path and getting, so we're not, and not having any examples like that linger is pretty critical.
Well, again, we encourage you to step that process up, as Richard said, but also keen to work with you so we can find the right answer and the right way to disclose this information. And I think perhaps it's a bit like the discussion we were having about asking your investee companies for information. I think we have to be clear in asking what we are asking from our investors.
I think that's a great thing to suggest, because I think, again, it shouldn't be that there needs to be pressure applied. It should be something that people are looking at and identifying and come and clean. And people obviously are suggesting, there are some market leaders out there who've come very clean, even if they've got quite high charges, actually, and that's good. Not to go to high charges, but to be transparent about it. But actually, if there's additional encouragement / pressure from asset owners, ultimately, then that's going to really help speed things up, I think.
Further comments or questions? James at the back. If you could let us know who you are and where you're from.
Hello, I'm Barbara Weber from B Capital Partners in infrastructure investment advisor in Zurich, Switzerland. I wanted to get back to your point. Your bigger picture was about not being mainstream and not getting stuck in your own traditional way of doing stuff. And I'm not too sure whether there's always a culture of reward. And that is both within an organization, but also outside of the organization. Because if you have a good idea, or you think you have a good idea, and you walk up to your potential clients, they might rather go with the mainstream because that's what they know, because they don't have a culture of reward in their organization for not being mainstream. And here it goes on, and so it's kind of self-fulfilling Main Street, right? On that point, you mentioned the sustainability issue, and actually I meant to raise that, so thanks for coming up with it anyway. And we believe strongly in it, and of course infrastructure investing is a huge, their climate change and all the ESG is a huge issue anyway, and both climate change affecting infrastructure assets and infrastructure assets affecting climate change. Now, when you walk up to investors thinking you have a good idea, because actually they should be thinking about it in their very own interest, because they represent people and it should be in their own, very own interest. Because that's the society, that's us, right? That's our world. More often than not only in the UK, also in Switzerland, my little research seems to suggest they don't really want it. Not that they are not asking for it, but even more so if you suggest it, they are afraid, and that gets us back to the mainstream, that, maybe somebody in their organization might ask a question whether this is a good idea, and they are not prepared to stand up for it. So suddenly you find yourself as an advisor or asset manager in an uphill struggle by trying to service somebody who doesn't want to be served. And I find that absolutely absurd. And so this is my plea for every investor and every culture in all these investment houses to actually honestly be open to, if not to everything, but at least to all these sustainability issues, because I do believe they are incredibly important. Thank you.
So there was sort of theme running through that of being conventional and not being prepared to sort of challenge the mainstream. And it's a bit like John Kay was talking about, sorry, I was pointing over there because I've already said it, it's better to be conventionally wrong than to be unconventionally right, sort of Maynard Keynes's comment. Are we too conventional?
Yeah, I think we are. And I think, and it is very uncomfortable. And as I said earlier, you don't necessarily get immediate gratification or any necessarily full sticking your head above the parapet sometimes. But I do think that if we don't each organise, there's both a risk of not being innovative enough, that I know is again the theme of a lot of this conference, in terms of, it makes you open and vulnerable to massive disruption. Whereas actually if each organisation, if each link in the chain became somewhat more innovative, encourage people to come up with ideas and to challenge the existing, the status quo, then actually we can protect ourselves, I think, from that. And that's where the sort of balance is sort of out of kilter at the moment. But it is it is uncomfortable to, when I set up 30% Club, I got hate mail from some of the chairman of some of the big British businesses, and I did actually feel like quitting, because I thought, why am I doing this? It's kind of on the side of my desk. I feel very passionately about it, but there was obviously some very enlightened people who were very supportive, and they end up being very helpful, obviously, and completely driving the change, because they were the sort of in crowd, and that was very important. But actually can be very uncomfortable, and I think it partly ends up you have to be a sort of certain person that doesn't, or you can be resilient and just think it's so important that I'm not motivated by exactly a quiet life or being conventionally wrong. That wouldn't appeal certainly to me. But I think, it's something that I would challenge and ask each of you in the room, but also people who are, for example, the consultants picking the next manager. Often there's a wait until there's a 5-year record, and I know you have to have processes and you have to manage things, but actually if anyone's coming up with new ideas, thoughtful ways of addressing some of the challenges that we see coming, it can be quite uncomfortable and quite lonely and quite unrewarding for quite some time. And then suddenly everybody wants what you've been doing for long time, and it's all a bit late then.
It's a new conventional thing, doesn't it? Yeah.
So it's hard, though. It's just the nature of how a lot of us are programmed, but just, being a little bit bold, a little bit more courageous, and actually thinking, this could turn out to be the best idea ever. I mean, try and think of it in a positive sort of way, rather than what could go wrong.
Okay.
You look at it and you have a very straightforward, practical way of quantifying, not everything, but parts, quantifying how it makes rational sense.
Okay.
Yeah.
Okay.
Yeah. No, I think that's.
Okay, thanks. Well, we've got a few minutes left now. Helena, you've talked a couple of times about Europe.
Well, because I wasn't going to do
Because
John Kay's.
you don't really have any views on Europe at all, do you?
I obviously have too many views on too many subjects. Well, I think the only thing is that I wanted to stress is, because I think obviously it's quite a controversial subject, there's a lot of heat and light, and people seem to love having a sort of point-scoring debates and very sort of character assassination of anyone who kind of there's a lot of noise around it, and we've still got quite a few months to go. Actually, on Sunday night. One of my younger children said, I just don't want to hear those letters. As we're sitting down to supper, by the way, I just don't want to hear those letters E and U again. This is kind of, as a dinner over conversation, she was ruling out that as a subject. So we have a long way to go. I suppose, from my point of view, again, going back to this speaking up and the importance of contributing to the discussion, this is obviously going to be a very significant issue for our country, and potentially for the EU itself. Obviously, there are now the attention is turning to, well, what would happen to the rest of the EU were the people of this country to decide to leave. I take the view that actually, the big fear project, it's not necessarily like that. I'm very pro the single market, and I'm very pro growth and the fund management industry and the financial services industry and so forth. But I do think that we need to be thoughtful about the fact that this isn't necessarily a slam the door, storm off, never talk to each other again kind of messy divorce, should that be what the British people decide to do. But instead, we could have, to paraphrase Gwyneth Paltrow, a sort of conscious uncoupling. There is a scenario whereby, we would have, we get a laugh of a serious subject here, but, it's true that we'd have this 2-year window. I am subscribed to something called Flexit, which has been written by Dr. Richard North. I'm not on commission. I just think it's it is a bit long, 420 pages, but I would commend you to it. It's about a scenario, people who think we could survive or thrive, as I do think we could if we left. It sets out a very measured scenario whereby we would retain our membership of the European Economic Area, which obviously encompasses then MiFID and so forth, and we had access to passporting certain financial services under that, and EFTA, and we initially adopt the whole of the EU acquis, and then over time, and we are not talking about 6 months, probably not even 2 years to complete this, we obviously would rewrite the statute book and decide which parts of that acquis we no longer need to have as a sort of, not part of the EU. I also think we need to recognise that, David Cameron set out a very compelling account of the EU at Bloomberg 3 years ago about the democratic deficit, about how the world, success in the world would require a certain flexibility of companies and countries. And we know that the EU hasn't reformed in that way. And so therefore we need to think quite long and hard about what kind of world we live in, the global nature of our world. And I just suppose I want to contribute those few thoughts just because I feel it ending up being quite politically charged, well, very politically charged. I mean, the Queen, for goodness sake, brought into the whole thing yesterday. I mean, there she is, quietly doing whatever she's doing.
Allegedly.
Allegedly, according to the Sun.
Before we get reported to the press.
No, don't worry, I'm not saying she was or she wasn't. It was just, suddenly she's dragged into the... And obviously, we need to be more, calm about it and more, actually what is the right thing. I think it'd be very confusing for everybody seeing such, pandemonium just in the debate, let alone what actually happens.
Yes, and that was certainly one of the key messages that came through the polling data that we saw yesterday, the sort of mood music that we were being reported to us yesterday. And as you say, we're only a month in. June the 23rd seems a very, very long way away at this point, doesn't it? But we are now out of time for this session. It's been a really fascinating discussion, so thank you very much for your time. And I'm delighted that we've got so much in common between our two organisations. And I think if we can move forward together on these important issues, transaction tax, some of those diversity issues, some of the workplace reporting issues, then I think we can make real progress. So thank you, Helena, for your time.
Thank you.
And if we can